Let's now recap briefly on the transactions of the balance of payments. We said that we can divide the balance of payments basically in two parts. The first part has current account entries, which are basically import and exports of goods and services, income receipts and income payments, and then gifts, so transactions without quid pro quo. The sum of all these transactions, which is with a plus if that transaction gives an influx into the pockets of local residents of currency, or it comes with a minus if it's a transaction that has an outflux of currency from the pockets of local residents towards foreigners. So the sum of all these transactions that I've just talked about gives us the current account balance. After the current account balance, after that balance, we have financial entries, which can be divided in capital account transactions, financial account transaction, and changes in international reserves. So those are financial entries. We're going to offer two theories that try to explain the behavior of the current account balance. The first one is going to be based on transactions that appear in the first part of the balance of payment. That's going to be the elasticity approach, which is going to explore how changes in the exchange rate can influence the current account balance of a country. The second theory, which we call intertemporal model, is going to focus on transactions in the second part of the balance of payments, and it's going to try to tell us how financial fluxes, financial movements across countries happen as a function of the real interest rate in the world. So we will first look at the elasticity approach, and we will see what it tells us, and then we will move on and look at the intertemporal model.